Hello everyone, and welcome to the second day of the PLSA's Investment Conference. And this session is also being live streamed, so welcome to those people watching us online as well. This morning we're going to be starting the day by talking about the future shape of DC investing. So as always, throughout the session today, please feel free to tweet your views using the hashtag PLSA Invest19. I wanted to remind you that you can ask our panelists any questions today via the app, and also if you're watching us on the live screen, you can use the chat box functionality that you should be able to see there to ask questions too. So, what does the future of DC investment hold? Well, investment options for DC schemes have been changing rapidly recently, and particularly the regulatory environment has been shifting beneath us as well. We've seen it start to encourage DC schemes to invest in asset classes that have once only been available to DB investors, for example, illiquid assets. And now you might be thinking, why have DC schemes not had access to these assets previously? Well, we've had an environment where it's more efficient for DC schemes to use things like platforms and administration services that are actually daily dealt and daily priced. And that's not really in line with using things such as illiquid asset classes. We've also had a regulatory environment that's really been focused on cost rather than opening up the investment universe to our members. So is this change a good thing? Over the next hour, our panelists are going to be discussing the DC environment, which could open up to new asset classes. Will these new investment opportunities get our members better outcomes? Or will there be negative aspects to this, such as fees? So to answer the key questions today, from what our asset classes are available to why we'd want to include them in our portfolios, we have our panel of three experts in the field of DC investment, Mark Jaffray, Emma Douglas, and Nico Aspinall. So I'm just going to hand over to them to introduce a little bit about themselves, tell us a bit more about their company and their experience in DC investment. Mark, are you happy to begin?
Yep, thanks Laura. Morning everyone. As Laura said, I'm Mark Jaffray. I work, I'm a partner and head of DC consulting and an investment consultant at Hymans Robertson. We are one of the largest independent advisors to the pensions industries. We advise trustees, corporates, and increasingly master trusts on their pensions and investment strategies. We have about 100 DC clients. We advise about 10 billion or so of assets within DC. We spend most of our time in investment consultant thinking about investment strategies, creating the best outcomes for members, and increasingly that's looking at illiquid investments.
Emma?
Yeah, so I'm Emma Douglas. So I'm chair of the PLSA Policy Board, but why I'm on this panel today is my role is also head of DC at Legal and General Investment Management. So we're playing a rather pointless game of top trumps before you came in to say who was the largest in all of these areas. So I think I can claim that we are the largest DC asset manager. So that's around 75 billion of assets in total. Now, around 32 billion of that is for bundled schemes, and that covers a wide range of clients and 3.2 million members. So, there's a good wide span there. And we've been working with some of our very largest DC clients, actually mainly own trust clients in the first instance, to look at how we can really add some sophistication into their DC portfolios. So that has involved looking at illiquids, but it has also involved looking at factor-based, ESG, all sorts of other investment innovation that I think we're actually starting to see really come through in the DC area now. And one of the things that we'll talk about, I'm sure, later is with Nico, we're involved in the patient capital review. So that's really focused on getting venture capital into DC. It really is quite an interesting one, that, because actually venture capital probably presents some of the very biggest challenges of an asset class that you're trying to get into DC. It's got high fees, it's got performance fees. I think for many people, the investment case is also unproven and it's very high risk. So, how do we allocate that? And of course, being remarkably illiquid as well, no daily trading. How do we get that type of asset class, indeed do we want to get that type of asset class into our DC portfolios? And I think that's actually given us a lot to think about when we're thinking about getting other illiquid asset classes in portfolios as well. And I think, really my view on all of this is we should be looking at this. It's really interesting, it's important, but only if we can deliver better returns to members. So, it shouldn't be a given that we need to add more things into DC portfolios. So I don't imagine there'll be any disagreement from the panel on that point of view. And then just one final point I'd like to make is just thinking about, the end member. And I do feel there might be some sort of slightly hidden at the moment, so quite latent member communication benefits of allocating to some of these asset classes. So one of the things that we had at Legal & General, it sort of fell slightly into disuse, but we're reviving it now. It was just a little app that showed people, in this case, where Legal & General was investing its money. So you could kind of click on your local area and see where money was being invested in things like, social housing, urban regeneration, retirement villages, but it kind of made the whole investment come a little bit more to life. So that was where Legal & General was investing its money. But I think that there must be something there in terms of if we could give members an app that showed them where their money was being invested and it actually made sense to them from a local perspective, they could relate to it much more. I really feel there's some great untapped potential there for member communications as well. Thanks, Emma. Nico?
So I'm Nico Aspinall. I'm the Chief Investment Officer of the People's Pension. In the top trumps of DC, I pull the largest DC scheme by assets. So we're just shy of 6 billion now. That covers about 2 million contributing members. That's about 4 million in total, and 85,000 employers. So we're very focused on the kind of small to medium end of the market, and therefore, we're an auto-enrollment product. It's a very interesting kind of time and point in the genesis of auto-enrollment where obviously the last step of phasing that's legislated for at the moment comes in next month. So after that, essentially, I think the distinctions between auto-enrollment providers and more traditional workplace providers will start to dissolve. So a lot of what I'm working on is thinking about how we face up to that challenge. And clearly, as you mentioned, factors, illiquid assets, thinking about idiosyncratic risk, starting to think about asset allocation in a more dynamic way, not a dynamic asset allocation process as you might know it, but certainly more than set and forget type strategies. So bringing out all of those kind of DB technologies and trying to put them into DC is very helpful for me because I've got some defined benefit in my role profile. So I look after some legacy schemes within B&C, that's the sponsor of the People's Pension. So I get a bit of that kind of compare and contrast, but I'm sure we'll come on to some of those points.
Thanks, Nico. So we've started to talk a little bit about the types of asset classes, but can we just think about, so what are we talking about? We want to open up the DC investment universe. What assets are we thinking that we need to add to portfolios, and really what is the investment case? Why do we want to add these asset classes?
Yeah, good starting question. So I think what we're talking about is we're talking about various asset classes, and I think we're talking about various asset classes at various phases of the member journey as well. So far from retirement, I think the vast majority of DC members are largely exposed to equities. Makes a lot of sense if you've got a 30, 40-year time horizon to think about capturing return premium and illiquidity premium from the likes of venture capital or other types of alternative assets, infrastructure, and some specialist property type thing. I think when you move through the member journey, you probably want to start to dial down that and think about other asset classes as well, introducing other asset classes and thinking about disinvesting from those types of asset classes to a more diversified portfolio, and you maybe introduce more debt type assets, private debt, and capture the illiquidity premium there. And then through retirement is an interesting one. So that's when people need liquidity, but they also need income. And some of the illiquid asset classes, that particularly private debt or alternative debt type assets, can offer good income opportunities as well. But that's a real challenge because of the liquidity needs at that end of the spectrum. So why invest? It's greater returns far from retirement. It's about diversifying your portfolio to reduce risk or improve risk-adjusted returns. And then there's also something about income generation as well.
Yeah. Emma, Nico, do you want to add anything?
Yeah, I mean, I think that's a really good answer that Mark's given. I suppose what we're seeing is there's probably more demand for infrastructure assets, be that equity or debt, than there is, say, for the venture capital type. That's in terms of the demand that we're seeing at the moment. And then, it is an interesting one, because some of the ways that we've dealt with accessing some of these, more esoteric asset classes at the moment are not necessarily through holding that asset class directly. So, you can hold REITs rather than property. You can hold listed private equity rather than the private equities themselves. So there's ways that we can do this now in our portfolios, and that's what we do in our main multi-asset fund. So that's a £13 billion fund. So, it's not short of a few assets to invest, but it's really quite cost constrained. We're trying to invest that money within a 13 basis points fee cap. And so, generally, I think, to be realistic, that's probably what we've got to spend in DC. When we were having discussions around the patient capital review, lots of talk about the charge cap. The charge cap's almost irrelevant. So when you get down to it, you've probably got between 10 and 15 basis points, as we stand at the moment, to allocate to your main default investment. So maybe it's not going to be possible to hold some of these illiquids directly, and we have to think about how else we hold them. That there's all the questions there about, is a listed version of this asset class actually just going to perform like equities rather than the underlying asset class? We totally get that. But I think there possibly has to be some element of compromise here about how we get that into our portfolios.
You talked a bit there about the 10 to 15 basis points. Do you think that kind of cost constraints that you have at the moment will change over time? Do you think that in the future you will have more budget to spend on investment?
I think potentially we will. Or, I mean, obviously it's, the cap and where we're talking about fees, it's all member-borne charges. And so that will include administration as well. So as administration gets more efficient, I do see the costs going down there. So potentially you have more budget to spend on your, investment side of things. But equally, fee pressure in market is relentlessly downwards. So I wouldn't be, saying that there's going to be a lot of extra budget. These are just the realities of DC at the moment. And rather than talk theoretically about how it works, I think it's always better to bring it down to, okay, this is a multi-asset fund. It's very mainstream in DC. How can it access these types of investment? And then on the other side of things, you do have perhaps some slightly more interesting ideas coming from the larger own trust schemes. And often there, the administration is being paid by the employer. So potentially there's a little bit more investment freedom because you've got a little bit more fee budget to play with there. Yeah,
we're certainly seeing that. So it's starting to see more of the own trusts actually start to create things that are more interesting from that perspective. Mark, if you've
I mean, I think Emma makes a really good point. I think the charge cap per se is not so much the barrier to investing. Often the barrier that we find is what the fee that's been charged to members now, that there's no desire to raise the fee to members. So any introduction of new asset classes, new managers has to be essentially about, can you get enough scale in the assets you've got to reduce the fees for your current managers to plug in a new manager or a new mandate at a higher fee. So that tends to be more the constraint than the charge cap per se.
So Nico, you've got scale. So
well, we've got the ramp of scale. Right?
Yeah.
So just shy of 6 billion now. That's not enough to go and push the 250 basis point venture capital world to become 50 bips or whatever I need it to be to invest in. I fully agree that the dynamic has shifted between what's the right price to what's the right scale to achieve things at that price. Obviously, with our recent announcement in terms of how our fees work for individual members, so that essentially the more an individual has in their pot in the people's pension, the more their AMC reduces. So when you have £50,000 or more, you're paying 20 basis points on that portion, means that ultimately, we're obviously not going to cross-subsidise investment, so there must be implicitly in that a sort of 20 basis point investment top-end budget. So yeah, that 10 to 15, okay.
Could go up a bit.
Could go up a bit, exactly. And we'll have to see how competition goes as to whether actually it's more important to members, more important to the decision makers that 20 drops, or that we spend more on investment. I think at this point in the journey, so scale is two things. I know, in very broad terms, that I'm going to receive about £3 billion next year, or next financial year from April, or really from May, because payrolls take a month to achieve. So that's £10 million a day, roughly, a bit more. In terms of liquidity, we need to start realising that my liquidity problem is not the same as a defined benefit scheme's liquidity problem. So my liquidity problem is that every single day my bank account fills up with a cash drag, which I need to get invested. It's not the same as holding an illiquid asset and being a forced seller at the point. And indeed, there are opportunities I'm sure that we can have in the secondaries market to be a buyer in a point where the forced seller is realising that they hold an asset that's maybe more liquid or at a wrong time and all that kind of piece. So I think we do have the opportunity to construct a long-term portfolio which is a forever evergreen type portfolio. I don't think that can be, that's not going to be 75% of what we invest for liquidity reasons, but the real reason it's not going to be 40% is for cost reasons. So actually the practical thing is budget at this point. And to come right back to the question, I think I agree with the kind of emphasis of the answer is it's not really new names on my spreadsheet of asset classes. We should see ourselves as being investors in the economy. So the question is, how do you go and access the economy? I have some concerns around the volatility of listed assets. So if we're going to talk about REITs becoming equities, they're sort of getting infected with this volatility thing. It's not about the underlying economic activity of a building, where a renter pays, their rent every 3-6 months. It's actually more about the market getting overexcited about stuff all the time and delegating a lot of its trading to a computer that takes microseconds to get overexcited all the time. So we need to be sensitive to what the true access that a DC member needs into the economy is, and not being too distorted by kind of how things are done in vehicles, how they're done in terms of market access. If we think we can innovate a way to save money, to get us into a place where instead of being 250 basis points for venture capitalists, 25 basis points, and come and check me in 2040, right? So see how long it takes to get there. But that has to be the mindset, getting access to the right parts of the economy for our long-term themes at a price that gives the value to members. And ultimately, it's not a purist value, which is if I pay 250 basis points and get 1,000 points of performance, that's good. Well, if I can't afford 250 basis points, there's just a line that I can't go above.
Okay. So you've been talking a bit about innovation and trying to access different parts of the market. Is there things that we can learn from abroad, US, Europe, Australia, thinking about kind of supers and what they've been doing? Obviously, there's quite a lot of infrastructure in those situations. Is there anything that you think that we could learn from elsewhere?
Yeah, I'm very interested in the Australian model. I think IFM has done a great job at essentially being the illiquid asset investor of choice for 17, I think, super funds all own it. There's a lot of, I say politics in the best possible way, in that they have individual states on board to say, and they have a concept called asset recycling, which moves things from the private sector, from the public sector to the private sector, but does it in the right way, because if you do that into a pension asset, then obviously we'll hold it and we'll look after it and we'll love it, and instead of it being, for someone trying to strip that asset, essentially. So I can see that model working. We're very different from Australia in a number of ways. I don't think they've got sort of a couple of hundred scaled super trusts. I think we're going to have 20 or fewer, and maybe that's another top trumps game that we can play. So actually the access route might be quite different. They also are more comfortable, and it's coming down, but they're more comfortable with higher fees in their product structure, and therefore IFM, and that illiquid side has a bigger budget than I think it would be likely for us to put in place. But I think that kind of model of collaborative working across the industry, getting us into a place where we can have a shared vision. I'm very keen on us talking up, I guess, UK assets, because this is the capital from UK work. So it ought not to go as much overseas as a market portfolio might suggest. That would be my sense. That's a very interesting point for us to discuss with our economists. But yeah, so that kind of model in Australia, I think, works quite well. I'm also really interested in, there's a couple of European institutions who are in the low single-digit basis points of cost. So there's a state savings company in Sweden who charge 3 basis points called Electa. That's 8 billion euros. And I don't know what their secret sauce is, but I want to find out. So I suspect they don't look anything like what a DC pensions trust would. And so don't be looking out for the 3 basis point announcement from us. But there is a lot more to be done in terms of saying a lot of the structures we invest through were designed in the 1980s.
Yeah.
Well, we've got the computer now. So what is all that cost doing? At my scale, do I need to use funds or fund managers? Can I go away from wrapping things and use segregated accounts? Because I've got a trust structure, there's enough legal protection in place, actually directly holding securities, directly holding LLP, GP investments may well be the right route to go. So we've got to work through a lot of those ramifications, but if that saves money and enables us to access more of this, then we should be doing those things.
Okay. So if people are thinking about this, do you think there's kind of a size constraint on trusts or master trusts that are thinking about this? And also if they are thinking about this, to add on to that, is there any other kind of constraints, bear traps, negative things that people should be thinking about? Performance fees is something that hits the headlines a lot, so I wonder if there's any comments on any of those issues.
Yeah, I think performance fees are just a challenge that we haven't solved yet in DC, Laura. So the recent consultation, that there are some paragraphs in there on performance fees. So, there's some ideas out there, but it's just, it's the inequality because, performance fees tend to be charged, and certainly if you look at venture capital, it's over really quite a long period. I was talking to the venture capital guys the other day and they were saying, well, our performance fees will be over 12 years. You think, well, yeah, and that's great if you've got DC investors who are in that fund for that 12-year period, and that would be fantastic. But of course, that's not the reality of it. And we've got members coming in and out all the time of the fund. So it's really hard to see how we can make that work.
Yeah.
And so the option is then you say, well, let's create a class of this fund that doesn't have performance fees attached to it. But then, what does that mean? Well, it means that the base AMC goes up hugely. And so we're back to that challenge again. And also, you could argue, has that hugely then disincentivized the managers, who live for their 2 and 20? They don't get that anymore. So maybe the DC portfolio doesn't get all of the exciting ideas. You feel that just because we can't really manage performance fees, though if there's ideas in the room, I'd really love to hear them, because if we could crack this, that would really help us in some of these illiquid vehicles, not all of them, but some of them, particularly the venture capital side. That it's just so important that we can find a way to get all the benefits of that asset class in a way that can be divided up properly and equitably between the different classes of members in that overall DC fund.
Yeah.
I mean, I think there are problems with the structure of performance fees, and the recent consultation kind of highlights that probably uncapped carry, and not to get too technical about it, probably won't work in DC.
Yeah.
But I think my focus would be more on just the overall cost of this asset class, and I'm kind of agnostic as to whether it sits in a fixed AMC or a performance fee or some other hybrid, as long as I'm transparent as to that they earn it.
Yeah.
and indeed that it works with whatever compliance I have to have. So I'm more concerned in getting the 20 or the 2 down than caring whether it's a 2.5 in the fixed AMC or a 25 in the performance. I'm kind of agnostic. My sense is just generically, I would rather have as small as possible non-performance fee, because that's free money. So I get that I need to support your business for origination. I think a bigger proportion of whatever the kind of gross estimated fee is should be performance. That would be my sense. Yeah. But then the practical world of DC might well slam into that. So I'm trying to be quite tactical about this and say, essentially, what is the kind of amount that we would be willing to spend? We have to realise it's a global capital market. So if the switch, the tap of pensions assets going into venture capital gets turned off, they probably won't notice in the world of venture capital. So there's no point in us telling ourselves that we can come along with £10 million and demand a reform of their market, because they're dealing with very, very different institutions. So that's part of, I guess, what the Patient Capital Review is trying to think about. How do we get enough money in a pot that we can go to the VC market and say, actually, your cost structure, it doesn't work. We don't just have this, I don't know what the number is, 2-3 billion today, but we're certain we're going to have 2-3 billion a year from now on, or whatever the numbers, that kind of dynamic. Now we think you can come and play. So the test for us is, so from that strategic leverage perspective, what are those numbers? And if it has to be 10 billion, then it's 2025. It has to be 100 billion, then it's 2035. We've got to get that framework, because I don't think any of us can afford to play with their current cost models. And we need to have this sort of tipping point where we can go and say, actually, your costs have to change.
Yeah, it just goes back to what Emma was saying. I really struggle with the whole performance fees with individual members. It's just such a different environment to what they're used to at the moment, isn't it? They need to understand our complexities as well.
But there's part of one of the pieces that I asked my compliance guys around the charge cap consultation is, there's one thing, if I invest in one 5 million, venture capital opportunity and it grows by 1,000% and I pay a performance fee on that and it blows out my charge cap, right? That's one problem. The reality is I'm going to invest in 100 of these things and only 2 of them are going to return 1,000%. A chunk of them are going to return minus 100%. And actually in the diversification overall is, a smaller overall cost. And then of course I do that every single year. So I get into an evergreen portfolio where all of those performance fees are, probably cyclical, but at the same time, more diversified across, temporally across the time of the portfolio. So I think that starts to assuage those kind of individual member problems, which are fundamental. Yeah. There's a valuation piece in there as well, which maybe we'll come back onto. But ultimately, that sort of destination portfolio, a nice mixture of different sectors, of different risk levels in VC, of maturity in terms of types of VC, in terms of time of when those VC investments were made, that lovely diversified portfolio, I'd be reasonably happy kind of putting into a sort of any member's portfolio. Okay, and we've got a glide path, right? So there's ways to take it away from them in terms of approaching retirement. It's the build-up over the next 15, 20 years that I don't necessarily want in any one individual's portfolio. And that's the difficulty, that kind of dream state at the end is great, but the way of getting there is just can't touch us.
Can we talk a little bit about scale? So lots of the things that we've been talking about are obviously only really accessible in huge scale. So there is some things that are now happening to get illiquid portfolios into other schemes of less size than that. I don't know if anyone wants to kind of touch on some of the innovation that we've seen in that area.
We've seen one particular fund, and we're seeing others come onto market, aren't we, that are addressing the performance fee issue by having the flat fee and making it daily dealing and daily liquid. So it does give opportunities for smaller schemes to tap into. And that's been, I think we're going to see more and more success, probably with that model. But to Nico's point, I think we're probably going to have to see those fees come down a notch for that to really get traction, because it's a difficult ask to allocate 5% of your default fund to a private markets allocation, and that puts up your fee to the member from 30 basis points to 40 basis points. So they see a third increase in their fee just because of a 5% allocation to private markets. I think that's a difficult issue for the trustee to get their head around, and also a difficult issue to communicate to members. Just in terms of the other innovation, I would suggest is to Emma's point, there are listed alternatives, and actually if you look at the listed alternatives, they might not deal with the diversification away from daily market volatility, but they do, if you look at through those over long-term returns, and they do offer diversification. So there are some options to create your own listed alternative at a much lower cost. And we've seen more of that than actually buying into a relatively expensive, actively managed options.
Can I just have a plug for we've got a DC stream session, which is actually a real showcase of the Partners Group Fund and how JP Morgan actually use that within their DC scheme. So I won't steal the thunder because I'll be booed off the stage if I do, but there are live examples of how this can be done, how it works. And I think it's really interesting to see this actually starting to happen. Obviously, a very large scheme working with a company that had really thought through all of the issues of DC. So, although it's private equity and debt, it's daily dealt. There is gating on the way out if you can't get the money out. And there's been some really interesting challenges of, you can deal with that in a default fund, a very highly liquid default fund. You can generally do that. We shouldn't get too scared about that. But, what if you offer it to self-selectors? What happens then? So we're back to sort of some of the things that we've all dealt with more recently in terms of property funds and gating. Mm-hmm. That was when we first realised that Brexit was going to come. And, we've been spending a lot of time internally, working through, what happens at the end of March or whenever, when it's quite likely that property funds may have to gate again. And these issues are much more painful in DC and for DC members. It's not as painful as it was in the old days when, you had this point in time moment when you needed all of your assets because you wanted to take the tax-free cash, and then you needed to annuitize as well. So you needed all of your money at one point. Now we've got less of that, so pension freedoms helps a bit with some of these problems, but it doesn't really take them away. Members don't really like the idea that they can't get hold of their assets, potentially for 6 months, 12 months, all of that kind of thing. So there's some member messages around some of this as well. So these things, it's great. They're starting to be possible for another large scheme that we work with. We have got a truly illiquid holding. It's a holding that is sat there. It won't revalue for. There'll be periodic revaluations, but it's an 11-year closed fund. And that this is a proper illiquid asset, but that's part of a very big diversified fund. So again, you can make it work in giving valuations. The top fund of this, which is a very small part of it, does still have the daily price. Members can get out. There's a question of how you value that asset on an ongoing basis so that members who do leave get a fair price. Members who are coming in pay a fair price. That's really important in DC. But it is exciting to see that these things can be done. Yeah. And I think that what we all need to do when we're looking at these investments is think, is this worth the candle? Are we going to get enough return from these investments that we're paying higher fees for in order to make it worth it for DC investors, because they may have to pay a bit more, to Mark's point. I don't think there's necessarily a magic that says you can allocate 5 to 10% to these type of asset classes and it has no impact on your fees at all. I think it will have some form of impact. So we've got to make sure it's worth it.
Yeah, I would say with Obviously, we still need a bit of innovation for other schemes to be able to do things like what you were describing there with the 11-year closed fund. Not all platforms can do that. I know working together, that is something that you can do with LGIM, but there's not a whole range of platforms out there where that is accessible. So at the moment, it's still a small proportion of the market, unfortunately. So I'd want to see more innovation from all platforms, really, to be able to do that. I think that's a really key point. You've touched a bit on communications and some of the difficulties around members' understanding, particularly kind of self-select and defaults, and if there's any difference there. Do you have any kind of hints and tips for people thinking about this on the communication standpoint? Because this is obviously a very complex area for members to understand. Does anyone want to take that one?
Yeah, I mean, sorry, Mark, you go.
I was going to say, so if it's 95% of members are in the default, and a heavy proportion of those members are not investment experts and would rely to a large extent on their fiduciary, trustee, provider, whatever, to build that strategy for them. So I think communicating with that audience, you've got to strike a balance between whether you highlight how much of the risk you need to highlight to them, or whether that's actually risks that the trustee, fiduciary, provider have considered in a balanced kind of way and are happy to plug some of those assets into the default. So I think you've got to balance the need for communication with your audience. If you were to, I can't imagine going out to a scheme and blanket saying we're putting a load of stuff into illiquid assets and here's all the risks of that. If that membership weren't really very familiar with investing per se, I think you'd have to challenge yourself whether you're just creating worry and concern out of, or over creating worry and concern with the membership. So I think that I'm not suggesting you don't communicate anything, but it's a difficult one, how much you communicate on that. I think if it's a self-select, that's really easy. If it's a self-select fund, you put all the risk warnings on it and you communicate quite heavily what that fund does and you let people make their own choice. But within the default, I think you've got to find a balance about what you communicate and how much you communicate.
And I think that's why you have to be sure that you're doing this for the right reasons, because if you are doing it for the right reasons, there's lots of positive things to communicate to members. So it's, access to different forms of investment. Once you explain what venture capital is, people, I think, could be quite interested in the idea that, that they're getting a chance to invest in these real startup companies that, they wouldn't normally be able to invest in a DC scheme.
Yep.
But of course, alongside that, as ever, we've got to highlight the risks. As Nico was saying earlier, for all of those that absolutely shoot the lights out, the unicorns out there, there's plenty more where you've just lost all of your money. So, it's not what we normally talk to our DC investors about. And if it is in the default fund, it'll only be a small proportion of their assets. So again, you don't want to sort of blow it out of all proportion for members to think that, suddenly that this is a really, really risky investment. But you have to balance that with some part of this default. It is now invested in different asset classes, for a reason. We have to be able to articulate there's a really good reason because we think that it will deliver better outcomes for you over the long term. Otherwise, we absolutely shouldn't be doing that. But, I do think that some of these stories are stories. They're stories that will work for members, that members could get quite interested in. I do remember, I haven't done member presentations for a little while, but doing member presentations a few years ago, you could actually get people quite engaged with the idea of, if you pay more in, you could have a better standard of living in retirement, how what you pay in equates to what your employer is paying in, good news there. Oh, there's some tax relief as well. That was always news to people, which is so sad, but it was. And then you'd get on to the investment section, and that's when you could, sort of visibly sense the audience disengaging, despite trying to explain, in vivid detail how our multi-asset fund works. No one was interested. They just weren't. So perhaps if we've got some more stories, and I think that can come from things like venture capital, from infrastructure, certainly ESG, potentially then we've got more things to talk about. We've got something that might make people think, yeah, I get what my money's doing, and that means something to me. And now I'm a bit more interested in that. I'll go and look at a few other things that are on this website that I hadn't really looked at before, and I'll start to engage a little bit more. I'm not saying it's the silver bullet to member engagement in any way, but I think it's a positive force if we use it correctly.
Yeah, I get to make everyone jealous because some of these problems are solved by design in my job. And it's obviously the wisdom of the founders of the People's Pension. But look, we're not here to communicate to members about investments. It's not our job. Our job is to communicate to them about pensions. Mm-hmm. And investment is, for the vast, vast majority of people, a very confusing thing that happens along the journey to being able to retire. So I think it can be a massive red herring. And I love the narrative of stories, right? So if we take a step back and say our job is pensions and not investment, obviously my job is investment, but the job for members, then what enables a member to receive a good outcome in retirement is going to be a combination of them trusting us enough to put in the right amount of money, and obviously low fees and sensible returns in terms of the job it does. So there's definitely a communication exercise around the building of trust. And this is where I'm very interested in. We haven't sort of got into it, but what is this illiquidity premium, right? So we've been talking around illiquid assets, but what is the business case for them? I think there's two things there. One is that actually there's a negative premium on listed assets, which is hypervolatility in listed markets, which just erodes value. Solvency II gives you a matching adjustment for exactly that reason. So it's a negative premium on listed assets. I think there's a control premium on unlisted assets, which we haven't really talked about. And that comes down to us understanding, our values, our members' values. That's ESG. That's a whole host of issues which may well come up in the next session, so I don't want to breach too many of them. But labour practice, very important to us in terms of, we're sponsored by unions. We very much look after lower paid proportions of the UK workforce. So when you're in an illiquid space, you are the owner of that asset. You are potentially a member of that board for that asset. You are very much more in control. You can put your values into that business much better, or that property, or that, et cetera, et cetera. Those are the stories that I think members will make members trust. So when we say we bought this property, it had a energy efficiency rating of E, we took it up to AA. That means this building's ready for the next 20 years. And by the way, it's the very visible one that you see every day on your way to work. Yeah. That is attractive. That makes you go, the People's Pension, the Master Trust that I'm a member of, understands what it's about for me. Yeah. That's not a choice that I want to put in front of people. I don't want to make a choice which says, should we do climate change or not? Do you want to profit from destroying the world or not? That's not how self-select is built. And and it may be uniquely ours, if our access rationale for illiquid assets is around that control, values, and the link to our ESG type topics, then it can't be a self-select choice. Yeah. Not just the liquidity, but just as us from a waterfront organisation, we can't have toxic things on the waterfront. Mm-hmm. So the negation of toxicity is, sorry, that's too complicated for the morning. So, I can't offer something which demonstrates that everything else we do is wrong. Yeah. Right? So I'm still not very comfortable with having an ethical fund. Mm-hmm. And we as an industry have ethical funds, and it suggests that everything else is unethical. Well, I'd much rather have the default, which is 99% of my assets, to the standard of ESG that we think is right. And then if members think we're wrong, they can go further. So maybe that's a branding exercise. Mm-hmm. But the illiquid piece, ultimately, all the liquidity comes from the default, even in your self-select members where you've managed to get, I don't know what the records are out there. There's some interesting single employer trusts with high self-select.
Oh, there are, yeah.
But that's mostly because it was pre-auto enrolment and they had to choose. So I ran a Barclays trust where you forced members to choose, and guess what? Yeah. Roughly 4 funds, 1/4 of people in the default. It wasn't, So I think the default is where the liquidity is. If we have a theory of the return from illiquid assets, which is around our values, the communication is about the default, the trust that we build in the default with those assets, and the link to what it's doing as a part of the journey. But it's not an investment communication in that way.
Yeah. Mark, Emma, so Nico's been touching on the importance of ESG in the default. Do you think that is the future of DC investment? Will we be seeing more and more trust-based schemes and others offering defaults that are ESG related?
Yeah, I mean, I think it's definitely a trend that we're seeing. I think we've got a lot of activity with DC trustees, particularly on responsible investment. Partly, I think, driven by the regulation requiring statement of investment principles to make a statement about it. That focuses the mind, but I think it's driven also by a general societal kind of trend of wanting to be more responsible with how members' money is invested. And I think to Nico's points, there is some evidence that when you ask people what they're interested about, they're more interested about how the money's invested. Is it invested in a responsible way than actually where, what types of assets it's invested in. So there is that kind of that responsible angle does resonate with members, and I think that's forcing a definite sea change. And there are solutions out there. So that's another sea change we've seen in the industry. There are products and funds available that do follow a much more responsible way.
Yeah, I certainly see that trend increasing. So, most people in the room, and Mark Thompson's in the audience, I know, will know about, the Future World Fund, global equity, factor-based, ESG tilted fund that we developed with HSBC. And what we're looking at now is kind of extending particularly some of those climate tilts to other asset classes, because, a lot of our defaults rely quite heavily on diversified growth funds. So, it has to be kind of something that we can make work across multi-assets, not just equities. So, we're launching a kind of what we're calling a Future World Multi-Asset Fund. So that has equities covered, corporate bonds covered, and it gets less green as you go on to some other asset classes where it's harder to apply a climate tilt or to create an index that then has that climate tilt in it. So, government bonds doesn't really work. Harder to do with, emerging markets at the moment. That will probably come over time. So I see kind of almost a gradual greening. If you think of your pie chart of the multi-asset fund, all of its different bits, I can see it gradually kind of greening round that circle. Not all bits of it we can apply those, the full climate tilt to. Obviously, you can apply the governance principles to. ESG is more than just the E bit of it. But I can see definitely a lot of progress coming in that area. And that is an area that does catch a member's imagination as well. So we did a survey, actually it's for the Legal & General staff scheme. So, obviously we have to eat our own cooking and people have to go into our group personal pension. And we did a survey just to kind of test attitudes on how important were ESG factors to our staff, members of our pension scheme. And we said that we would plant a tree for every survey that was filled in. And then we had to close the survey early because I ran out of my tree planting budget very, very early. There was that much demand for it. I did mention this at a Share Action event and they looked at me in horror that you've stopped planting trees. But, the budget was the budget. There was nothing more I could do. But it was just fascinating to see that there was that much interest and that much demand. And that's not just LGIM, it's all of the people across Legal & General Group as well. So it's not people who are always thinking about investment day to day.
Yeah, I'm really seeing that across all my clients. It's really amazing how DC is really pushing this forward, I think, in comparison because of the longer term timeframes that we have here.
I certainly think we ought to have this kind of mindset which says, first off, what can we learn from DB, like positively, because there's just so many more. We'll come back to asset classes, but routes of accessing the economy in a DB world. But then there's also, what can we do better than DB? And I think there's two critical, necessity is the mother of invention, and our necessity is low budgets. And because we've got a different time horizon, ESG, and ultimately, I think the fund contribution can innovate in those spaces and get ahead of the curve. And whether DB, will kind of, in a mass sense, will still be around by the time we solve those problems, or whether it can actually come and, participate in those solutions, I don't know. But clearly, we look more like a retail market, and what we're doing for 10 to 15 basis points, every retail investor in the world should be biting our hands off for. So, you know, we can be the heart of a disruption of the financial services system, which may be quite scary for us, right? I mean, this is going to be, the next 10 years may have as much history as the previous 100, right? It's crazy, but it's true. That's what the singularity and the acceleration of society means. So if we see ourselves in that right space of the challenge, so how do we get enough scale into VC to get the cost down? How do we get the right data on the E, the S, and the G, such that we can do the tilts, such that we can have a properly integrated factor portfolio, such that we can manage those hypervolatilities of listed asset classes, access the unlisted in the right way? That's a pretty compelling package compared to where the industry was 5-10 years ago, and where it is today in the space of retail land.
So I just wanted to open up the floor in case there was any questions from our panelists from you today. If you could put your hands up. Yes, there's one in the front middle. The microphone's just coming behind you.
Hi, thanks for an excellent session. My name is Amlan Roy. I'm with SSGA and LSE. My question is to Nico, Emma, and the third participant, but what do you think is the biggest challenge you see in 12 months for you? And I somewhat disagree with Nico, because Nico says, oh, money comes into DC. The problem partly is, how do you demonstrate that you've got the performance to tempt people much more into savings and really fulfill the dream which we would like you to see? And for Emma, the question is, you could tap into Legal & General's other entities to try and get some transfer subsidies on real estate, LNG capital, infrastructure. That's what's happening in US, that's what's happening a lot in Netherlands, and pass it on to other DC clients of yours. Your reactions on those, please.
Shall I start? So, I think you have to remember this is an inertial policy. So auto-enrollment is about getting people in through their employment and not getting people to choose. We know in markets where individuals choose which provider they use, that the price goes up because a lot of the money goes towards marketing. So it's important that we have the right choices in front of people, and it's not just choice in this kind of Chicago school, everyone's rational kind of person. So we need to be very, very strategic about the choices that we put in front of people. And absolutely part of that narrative of trust is getting the right level of contributions. Now, this is a difficult set of discussions to have with, and this is so, I'm sure, hubristic, like, with a millennial who's got loads of debt and, they're constantly on Snapchat. Does that exist still? I don't know. They're doing all of these kind of things in the short term and instant gratification world, and we've got to somehow get them interested in being 70, which no 22-year-old is that excited by. So these are difficult challenges, and behavioral finance, behavioral economics is the route to solving those problems. So when you say performance, I think there's a big risk, actually, that we get back of the Sunday personal finance column, Sunday papers personal finance columns, which is how we did over the last 3 months. That cannot be the performance measures that we have. I have to wait for 50 years for the performance measures I want, which is what did you get over the full journey of being with us, right? So I get that I have to have something before 2066 or whatever it is, when our first 22-year-old was turned 72. So we have to understand it's not performance in that, again, retail, did I track a benchmark or not, or outperform or underperform a benchmark or not. Our objectives must be inflation linked. That's the real thing that people face. It's very hard. Even that step is very hard. I remember having a trustee tell me off that a DGF had underperformed its benchmark by 300 basis points in the last quarter. It's like, no, that's inflation was its benchmark, and the market, wrote off. Yeah. That's a trustee. having that conversation 4 million times with members is going to be impossible. So we need to get it to a right level where we're talking to them about their long-term objectives in the context of performance. So yeah, there's a huge amount of work left to do. I'm not pretending we've got the kind of fixed solution here. But I think if we've got the right kind of attitude and values at heart in terms of our approach, then I think we'll go in the right direction.
Yeah, I'd certainly agree with your comments there, Nico. Sometimes, I refer to my business as being powered by inertia, which is, and actually when I say that, all senior management gets really nervous. But actually all it's saying is that, we're just using behavioural economics in the right way. So people are in, and then they think about, oh, shall I opt out? But it's too much hassle, and they don't opt out, and that way they'll get a better standard of living in retirement. So, it's a positive. Getting our default funds right is absolutely vital. And then in terms of the specific question to me, yes, absolutely, we are talking to other bits of Legal and General. And I think that the thing we have to be really careful about there is just the conflicts point. So what you've got to make sure is that everyone is investing on a level playing field here, so that, if there's gain or there's pain, everyone shares it equally, the fund, the group, all participants. So, that's a fundamental principle. Some of the discussions around fees are quite painful because I haven't got that fee budget in DC, but those discussions absolutely are happening, and I think they'll be quite productive in terms of getting some of these asset classes into our portfolios.
Can I just come back on the next 12 months as well? Because I deliberately skipped it. Did I deliberately skip it? Phasing, right? So we went through phasing this time last year, roughly this time in April. We've got to exude enough trust for the members who go, blimey, what's happened to my paycheck this month? To go, oh, it's fine, it's looking after me in the future. And if we, again, it's inertial. So we're not putting adverts up on the TV to go, isn't it exciting? There are posters that we provide to employers to help them take their people through that journey, but ultimately it should come across as something that it's right the government's making you do, basically. That could land badly if there are various things happen in I don't know, around the 29th of March, for instance. So it's very easy for us to get blown off that course. So I think we do need to be quite resolute around what the messaging is there. But yeah, if we achieve one thing in the next 12 months, it must be retaining a substantial proportion of people contributing at the higher level.
So one more question from the app. How much of the demand for illiquid investments is really driven by investors rather than members? And that's something that we've seen with the DWP consultation. There were some negative points about maybe demand being driven by government. So do you think it really is driven by us, or is this something that's going to benefit members?
So just really quickly on that one, I've not had an experience with a scheme where a member's asked for it, ever. So I think it's been driven by, it's probably been driven the right way by governments and by the industry that see there's an asset class there that DC schemes don't get access to. It could be useful to both returns and to risk, and so should be plugged in at the right cost. Just really other really quick point. What we focused on today is on illiquid assets. A lot of DC schemes, in the same way as we're really used to investing in global equities, don't invest in global small cap, which has quite a high correlation with private equity returns. Don't invest in global real estate, and don't really invest in global bonds. So there's a lot of listed assets that I think we could usefully focus on as well.
Mm.
I don't think there is that groundswell of member demand because there isn't, and if you rely on apathy to get people, into a pension, it's quite hard then to say, and then we need to be really engaged and demand exciting new investments. So I don't think it's coming from the members, but it has to then be coming from, the industry, from us, of have we got the right asset classes available to our DC investors. But, it does come back to, we can't just be doing this because it's quite an interesting intellectual thing to do. We have to be doing this because this will get better outcomes for members.
Yeah, I was just going to make maybe a point I should have said right up front. So we've been using the word illiquid. I think we meant unlisted. my listed portfolio has illiquid assets in it. I just don't know that until they become, the proverbial hits the fan and I can't find a buyer for them, right? So we shouldn't delude ourselves that these listed products are always liquid, and indeed, depending on how you construct your fund setup, you can make sure it's illiquid, and that's a very bad thing to do. So the traditional kind of long corporates funds, if I've got a 15-year duration, there's not many issuers in that kind of time. If I'm trying to match annuities back in the day, we always kind of told ourselves that these were liquid, but actually we were saying they were listed. So I think we need to be kind of cautious around that. Yeah. So our positive cash flow as a set of DC schemes makes that liquidity thing kind of, irrelevant until they need to be sold. And then it's about listing or unlisting and control, in my view.
Thank you. Well, that's all we've got time for today. So I'd like to thank our panelists, Emma, Nico, and Mark, for their insights. As we mentioned earlier in the session today, there is the DWP consultation out on illiquids in DC. The PLSA will be responding to this, and if you have views, they'd really love to hear them. So please do visit Carolyn Escott at the PLSA stand in the break if you wish to share your views on that. So thanks again, and we'd like to welcome the next panelists to the stage for